welcome to the Selections podcast from Select Investors, a partner practice of St James Place. To everyone listening or watching, thank you very much for tuning in. My name is David Reynolds and I'm a senior partner and head of investment with Select Investors, a partner practice of St James Place. At SJP, we have a discretionary fund management business that operates in the UK under the name of Rowan Dartington. And today I'm delighted to be joined by Tim Cockerill, the investment director and head of responsible and values-based investing at RD. Hi, Tim. Thank you very much for taking the time to join us today.
Hello there.
Tim has had a long career in investment management and with a particular passion and speciality focus on ESG, environmental, social and governance investing, which has become, well, some 10 years after Tim's initial portfolios, a very important investment phrase and also boon in the investment industry at the moment. So Tim truly was a path leader in the way of that arena. Today we'll be discussing the role of a discretionary fund manager or a DFM, what it means and how it provides benefit to our clients. There is going to be a second part to today's podcast where we will speak about the current market situation and how RD is managing client portfolios now and preparing for the coming 6 to 12 months and beyond. But let's get into the discussion on DFMs today. Tim, a real pleasure to be talking with you today for this discussion. I've highlighted your ESG focus and credentials in that area. We'll get into that a little bit later, but can you talk to us briefly about your experience in the investment management industry?
I've been in it a rather long time now. I joined in the late 80s when it looked, well, certainly from a UK point of view, it looked very different to where it is today. And throughout all of that time, I've done fund research, portfolio management, macro research as well, built portfolios, managed portfolios. And of course, ESG has been a part of that. Although, to be honest, when I joined the industry, as I said, late 80s, it was known as ethical investing and was really on the periphery. So I'm pleased to see the last 5 years, the world has at long last embraced it.
Yeah, very much so. And the phrases around it have changed quite a lot over time. And they're, we'll come back to it again later. I think they're even coming under the light and the spotlight at the moment too. But in that time of the long time in the industry that you've been there, particularly maybe in the offshore wealth management space, but also the onshore, I've experienced various financial planning firms and wealth management businesses that pertain to managed client funds, but I've often found that it's led by product positioning and the investment portfolio and construction of portfolios. It's a bit of an afterthought and then indeed neglected after the initial investment. Can you tell us, have you experienced anything sort of similar?
No, absolutely. I think, again, from my point of view, the further I go back in time, the more I saw that it was very much a product sales process. And as you say, the investment part of it was more of an afterthought. And I mean, that's led, to really strange looking portfolios, which aren't terribly balanced. And I think that's one of the great things about DFM, and hopefully what Rowan Dartington can offer is it's the right wrapper, but also that DFM service sort of within it. The investment bit is a really important, key part of it. I know the tax planning, I know all of that is important, but the investment's critical too.
Yes, indeed. There's not a lot of point in protecting everything from a tax perspective if you've got nothing really to protect in that regard. So talk to us more about what does it mean to be a discretionary fund manager and how does a DFM differ from an in-house advisory manager for a financial advisory business, for example?
I mean, DFM really is quite simple in a way. I mean, what the client is doing is saying, we would like you, the DFM manager, to make all the decisions on our behalf without reference to them before you make a decision. So that means that we've got the freedom to make changes as and when we want to, and to make the changes we think are most appropriate for the client's objective and risk profile. The advisory approach is very much a two-way process in which if we were, and we do operate advisory accounts, you would talk to the client first. You say, look, we've got a fund, we think it's a good idea. And then the client obviously decides whether they want to invest in it or not. And it can come the other way, of course. The client themselves can say, well, I've seen this, I'm interested in that. I think it can, if you're not careful, be a more reactionary service. And I'm not convinced over the years I've seen it that you always end up with the best, the most diversified, balanced portfolios. But yeah, key thing is DFM, we're left to make all the decisions.
Yes, I think that, that's a nutshell of what it is versus an advisory, really. But in your experience then, what is it so much about having the ability to make that investment decision on behalf of the client without the discussion, without their signature on a dealing instruction or a click these days, that can be of real benefit to them?
I think we can move, arguably, we can move more quickly. We have processes. Obviously, we look, for example, at asset allocation, and if we decide we wanted to increase equity, decrease equity, and start that process tomorrow, we can do it for all the clients who are in our DFM service. Whereas if you're in an advisory service, you have a much longer process. It's harder to get around all the clients at the same time. So we can also give a much more, I feel, consistent return to clients in general. So if take the classic medium risk balance client, because we can act at the same time for pretty much all of those clients as a whole tend to get a much similar return profile than you would through an advisory process.
So you say it just allows you to be a bit more active and a bit more react a bit quicker to changes that you want to implement, rather than having to wait for a conversation with a client who may be traveling, or particularly in this part of the world, I suppose.
Yes, and I think also, clients will have, as I said, their own ideas, and we may, you may not feel that that's appropriate for a particular portfolio, but clearly if the client wants to do it, the client can do it. So I think you should get, I'm going to say, I'm biased, of course, you'll get a better quality portfolio, one which is thought through, because we look at the portfolios as a whole. We're not looking at the individual funds or stocks, whatever it is, in isolation. And I think sometimes from an advisory point of view, that can happen. Something pops onto their radar. Hey, look, this is a really interesting fund. Let's put it in the portfolio. Well, we don't look at it quite in that way. We might look at a fund like that and say, okay, how does that fit in? How big a weighting do we want? Is it appropriate? Is it duplicating something we've got? How's it going to react in different market conditions? So there's kind of a lot of more, I can say, there's a lot of thought that goes into the construction of the portfolios, because it's trying to get the whole working together, which is one of the key things we're aiming for.
Yes, yeah, I suppose, and sometimes if you wanted to take a more, not necessarily a short term, but an asset allocation position that maybe wasn't particularly a long-term strategy, it could allow you to take that and take advantage of it, rather than implement it too late and then come out of it too late as well on the other side, I suppose.
Yeah, I mean,
we have to avoid that on an advisory basis.
I think, in an ideal world, absolutely, you could take a tactical position, and we do, but you have to look at how long does tactical mean. It could be 3 months, it could be 6, it could be 12.
Yeah.
And sometimes against a strategic position, because we have strategic positions in our portfolios, you take a longer term tactical allocation. And of course, the whole thing is managed, it's monitored. If we're watching a fund or a stock and we decide that we need to switch out of it because let's say it's not performing so well, we can do that, and we can do it quickly. Again, advisory service, it's a case of client by client, going to them, talking to them, explaining. Maybe some want to follow, maybe some don't follow. Whereas we've got control over that type of decision. And it makes it much easier for us to then go back to the client and kind of talk about the portfolio and performance.
Yeah, that's very true. And I suppose you're looking really at sort of for each risk risk attitude, level of risk portfolio, you're looking after one portfolio. Whereas if you've got slight variations for different clients, where maybe they didn't take the last change that you advised, or added something in that, an extra tactical asset allocation that they wanted, then on an advisory basis, we would have to be monitoring each portfolio almost individually and assess it in regards to making a change each time, which is a bit more time consuming.
Yes. Yeah, and that's the other thing. Obviously, we've got the systems which allow us to do that monitoring. And whilst we bespoke portfolios, and you do get variations, they are all built around models. So, for example, we in specie client portfolios, and that newly in specie portfolio may look quite different from our ideal model for that client, and we work that portfolio towards the model. But you need the system to be able to do it. And whilst we're doing it at an individual level, it's all effectively bulked up when we make changes. So again, those top level decisions, fund stock decisions, get swept up into that process, even if you take the example of that in specie transferred client. So a big part of it is that the ability to manage a lot of clients around models and the ideal positioning, even if they're not there at the minute.
Yeah, absolutely. I mean, and for different clients, rather than sort of the benefit to sort of the larger, the sort of massive clients, I suppose, in that regard, have you noticed any sort of significant interest or benefit for clients who are sometimes more restricted in their ability to invest across the market, whether that's typically through their job, through their role, etc.?
I would say most of the restrictions we see tend to be placed by the client, and again, they would often be ESG related restrictions that the client has said, look, I don't want any alcohol, I don't want any tobacco, classic ones. Occasionally you do get company level restrictions. The one that comes to mind, to be honest, I don't think we see many, but the one that comes to mind is, for example, when you've got a big accountancy firm which is involved in the audit of company accounts, then that becomes quite difficult for those clients at times, because they're not allowed to invest in any of the investments in which that accountancy company has a connection. And I can remember a case where funnily enough, it was an ESG portfolio. And we said, look, this is the ideal portfolio. This is where we want to invest. And they came back and said, well, I can't do that one, or that one because of the connection. And so you end up looking for alternatives, or actually, funnily enough, in that case, the client did, I think, go down the advisory route because that was the only way of managing that problem.
Yes, yeah. And actually, I think for me and for many of us out here in Singapore, it's fairly common for, as you say, someone in an accountancy firm that they can't invest in a company, or even maybe the asset manager where they're doing the audit of. But equally, often a lot of people in certain roles in banking need to put everything through their compliance, and then they can't. It almost provides not maybe an inability to invest in certain things, but extra layers of process that can be quite painful for them, particularly with single stocks, but also with active managed unit trusts and mutual funds, etc. So I've found, particularly for some clients in banking, that actually their restrictions can be quite arduous, and a discretionary service has really helped that, particularly if they're on the sales side of equities, etc. in a bank, and also legal. But one thing that comes up, I suppose, is the number of times clients or the amount clients are rewarded as part of their remuneration in company shares. So from their employer, they're allocated extra shares every year, and then they're sitting and holding those shares, and then they vest. And then at a particular level of seniority, there's several times throughout the year where, due to auditing or preparing their accounts, they won't be able to trade or sell those shares when maybe they actually want to, even if they don't know anything about what's
Mhm.
the information that's coming out. Do you have you seen that that's quite a an important thing where they can move those shares within the custody of RD, and then you could obviously they can't tell you when to then trade, but you can then sell those down over a period of time and divest for a client?
Yes, we offer we do offer actually a sell down service on the stockbroking side, where that type of, if it was suitable, that type of uh, stock for the client could be held. We also have what we refer to as a cherished holding category, where the client has, again, same type of situation, but the client probably doesn't want to sell the holding, but wants it included, sort of, if you like, from a valuation point of view, having it, custody all under one roof. But by making it a cherished holding, we ring fence it, so it doesn't become part of the DFM portfolio that we're managing for them. It sits outside of it, but it's still under our custody. And in the UK, that's quite common actually to see that. And the source of the shares can be inherited, and as you say, they could just be the company a client is working for.
Yes, yeah. I mean, it's I really enjoy looking at behavioral finance and the way that private clients react. And over the 15 years I've been out here in Asia working with private clients, talking about their company shares is always quite an interesting one, because a lot of the time people really believe in their employer. They really believe in what they're doing, and invariably don't become aware how overexposed they are within their net worth and their asset worth, where their income, pension, and a lot of their investment is all within and tied to one company. And
Yes.
often then when it comes to having that discussion about selling down or divesting a portfolio or into a wider portfolio from that single shareholding, it becomes very difficult for them to often think about selling some of it when they still want the, and still seeing the share price go higher later on. And it becomes a very emotionally difficult thing for people to do until they wish they had sometimes later down the line. So I think it can be a very good value add service when you are able to sell that down periodically for a client without the emotion that sits behind it, when you can look at it from a more technical, analytical point of view.
Yes, yeah. No, the behavioral side, the emotional side of investing it's something I think that sometimes gets overlooked. The market is often focused on the technicals, but the emotional behavioral side at times is very important. And absolutely, in that type of situation, it's tough. You have to say to yourself, I'm going to take some profit out of this holding and put it to work somewhere else. And then invariably the price goes up higher, and you're kicking yourself, because if you waited, you would have made that much more money. But then
they're still holding more, probably.
Yes, but then when you get market conditions like we have at the moment, and everything has tumbled a long way, that's when the situation you're referring to and the need to make sure you've got a balanced portfolio comes more to the fore, really.
Yeah, absolutely. So getting more into portfolio construction, how does RD build their portfolios? How do you construct a portfolio for a client, or for a risk appetite, etc.?
We have a risk framework, which I have an asset allocation risk framework. So the main framework goes from low risk through to high risk. There are 5 categories, and each of those risk profiles has what we would refer to as a neutral or a strategic asset allocation to equity, fixed interest, and alternatives. And obviously, as you go up the risk profile, you get more allocated to equity. And then underlying that, and this is the role of the asset allocation forum, is to determine, for example, in the equity space, how much is allocated to the US, to the Asian markets, to Europe, etc. And we meet every month to just review that. So our framework provides for, again, take your medium risk client, that tells you how much we have got in equity at this point in time, fixed interest alternatives. And then we have a portfolio construction forum, which looks at the securities that we want to hold in those different asset classes. And that in turn, that choice of security is driven by the research we do. So we have a fund research team, we have a direct equity research team, which is really specific to the UK, but they feed up into the portfolio construction committee, and it's all pulled together. So we end up with a series of models, what we refer to as our best ideas models, basically. And that will have the securities that we would ideally buy for a new client with new money today, and it provides the asset allocation, regional exposure as well. So that's how we put it all together.
Okay, so very much a top-down asset allocation approach, where you by asset class and then by geography.
That's right, and then the bottom-up bit is obviously done around more of a conviction approach. You know, it's looking at the funds. You know, what funds have we got belief in which are going to deliver? But again, the work and the construction portfolio is looking at what is probably going to drive an individual fund or a stock, and making sure across the portfolio, you know, we haven't, if you can avoid it, got too many eggs in one basket. Doesn't always feel like that when markets decide they're going to correlate going up or down, but you know, yeah, the process is there, and that is what we do.
And then how much, I suppose, you know, a couple of different questions there. How much are you then looking at the asset manager and the different investment styles of those asset managers, whether they're value, growth, quality, etc., whether they're, you know, small holdings, very focused, or whether they're sort of more broad? And another question then also, do you take any focus into sort of sectors, you know, whether it's technology, healthcare, consumer staples, etc., that sort of thing?
I think the simple answer is yes to all of that. We do look at, you know, very much the manager's style. You know, it's part of understanding the characteristics of a fund, and then you're looking at whether it's large cap, mid cap, how concentrated it is. So again, it's about trying to understand the nature of a fund and how it may react in different market conditions, and which other funds you might want to pair it with. And the same on the direct stock side in the UK. So yes, I mean, the more you understand the investments you're going into, hopefully you can construct a better portfolio. What we're trying to avoid is surprises, in that, you know, you invest in a fund, and it, you know, the market goes up and your fund goes sideways, and you're thinking, why is it doing that? Because that's not what I expected. That's what we absolutely aim to avoid. Yes.
Yeah. And in aiming to avoid that, I suppose that takes an awful lot of ongoing monitoring and potentially changes where it might be changing the asset manager rather than the asset allocation.
Yeah.
I suppose.
Yeah, I mean, a lot funds, as you'll know, are relatively slow moving. You know, once they have, you know, they launch and they set a mandate and they say, we are going to manage the money in the following way. And by and large, in my experience, most of them do stick to that. Yes, you get some drift occasionally. I think coming back to the psychology and, if you like, the behavioural bit, a lot of it, when you look at a fund, is about the manager and what the manager thinks and is doing, because fundamentally they've all got the same information at their disposal. You know, they've got the same market information, they've arguably got the same information about the underlying securities. It's how they interpret it. And so the psychology and what a manager looks for can be, I think, quite a key determinant of how well a fund does. And just occasionally, you know, you get managers who get to the point of thinking they're right and the market is wrong. You know, I mean, that's a bit of an extreme case, but that's
We've seen it though. It has happened. Yep.
Yes, yeah, it does happen, and no, absolutely. And it's good to see managers, because obviously we meet them face to face. You know, you meet the manager when they're doing really nicely and kind of everything's going their way, and then you meet them when things are not going the same way. And it's quite interesting to compare how they approach things and what they're saying in those two different situations. But it's rare that you would see a manager wanting to change their process, because they are really, really wedded to what they're doing and believe in it. But no, monitoring, absolutely. And we do change funds. Yes, of course. We change our views on market outlook, and you sometimes change a fund to reflect that outlook.
Yeah, absolutely. And I suppose that's quite a sort of good segue into what's been a wider debate for over, growing debate in the last decade, even more so, I suppose, really since financial crisis, and before then. So the active investment versus passive investment arguments, there's always a lot being written or presented about this, and it tends to be people quite passionate in one way or the other. But we've seen the rise of exchange traded funds, or ETFs, and also as robo advisors in that space, putting together portfolios of ETFs for people through algorithms, etc. So, do you want to maybe talk us through RD's position with regards to active versus passive investment?
I've always been on the side of the active manager. I mean, which is where SJP is really.
Absolutely.
And in one way, if you go back to our framework, and again, you take your medium risk framework and you say, well, we've got 65% in equity. If you use passives, you're really going to be tracking the market. You might have so much in the S&P 500, Euro stocks, the FTSE, etc. If you go for the active manager, you're still making that same weighting allocation, but I always feel you're giving yourself an extra layer of potential for return, because you're saying, no, we're not just going to buy the index, because the index has always got things in it that you really, really wouldn't want to hold, but you do because they're part of the index. So the active manager has an ability to obviously tilt their portfolios to the sectors, the areas which they think are going to do better, market cap, etc. So I've always thought that, you're making two decisions, asset allocation, and then you can add the active layer on the top. But I know kind of in this debate, a lot of the pro-passive people point at the average active manager and go, the average active manager does not necessarily often outperform. That might be the truth, but we're not looking for the average. Like SJP, we're looking for the better managers. And whilst all those managers will have periods when they don't perform well, that's just the nature of investment. Long term, and we're talking 5 years, 10 years, ideally that would be a great holding period. We believe those managers will outperform. So yeah, very much on the active camp.
Absolutely. Couldn't agree more, really. Also, I feel sometimes that the amount of money these days that follows an index is actually a growing risk in the world of volatility, I suppose, because as things sell off, the fact that things have to more collectively sell off to manage that, the amount of money in that index at the same weighting can really sort of increase volatility.
Yeah, I think putting money into those ETFs is easy to do. I think sometimes in really stressed conditions, getting money out, will have, particularly the big ones, can have a big impact on the liquidity, particularly of the smaller cap stocks, and that in turn has a knock-on effect. And I suspect, although I have no evidence for this, that active manager money may be stickier than passive money, because you have, if you like, you've got no loyalty to a passive vehicle. You've identified you want the S&P 500, who's the cheapest, we buy that. Whereas when we're looking at the US market, you do a lot of research, you meet the managers, you meet the team, you know who you're dealing with, you know what they're doing. So you're bought in a lot more to what they're doing. And I said, I have no evidence, but I suspect it's sticky.
Yes, I imagine so. And actually, it'll be interesting, in the year that we've had so far, which has been a very volatile one, with a lot of negative downward movement. Not that we're talking about markets today, or in this podcast, but in a scenario where markets are coming down significantly from their highs, the ETF or the passive will just track that all the way down, whereas active managers, I suppose, have a much greater degree of flexibility, or they actually have flexibility to be positioned to soften that downside risk, to take opportunities that arrive, to move money in and out of positions that they don't want to be in those unfavorable circumstances.
Yes, yeah, you often hear in this type of market condition managers talking about actually buying stocks that they've wanted to hold, but which they felt have been too highly valued. I think in the short term, active versus passive, who's going to give you the best return? It's really difficult to say, and there's too much focus really short term. I think we all need to step back and look long term. But absolutely, the active managers are in a place to take advantage of what we're seeing at the minute. These bear market conditions, and bear markets, after all, are part and parcel of the investment world. You have bull markets, you have bear markets. It's kind of just one of those facts of life, even if it feels quite painful, as it does at the moment.
Yeah, absolutely. And one of the other argument that's often used is just purely on a pricing point of view. ETFs are cheap or cheaper. Well,
Yeah.
mostly they're not all as cheap as one would think. But how, in confluence to that, how does Rowan Dartington manage the costs within their portfolios?
We have, obviously, first off, we're using third-party funds and we're using active managers. So the costs are higher. There's no question about that. But what we say basically is that the investment comes first. This goes back actually to your point about products in a way. We're building a portfolio and we want the best investments we can find. And if we find a fund and it's got a management charge, which let's say is a little bit higher than we would like, a bit higher than average, that won't stop us from buying the fund. Because if we believe that that fund is the best to deliver what we want from that investment, then the additional cost should be outweighed by the expected additional return. That's how we view it. And over the years, I've done one or two, I can't say they're hugely scientific tests, but sometimes you look at active funds which are charging more than passives, but the additional return you get for what is in some cases only a small increase in cost is, in my view, more than likely worth it. Now, the argument can go the other way around. When it's underperforming, you're paying more. And we have to look at it. We talk to the managers about it. We would always buy the cheapest units out there when we've identified a fund that we want to invest in. And we go back to the managers on a fairly regular basis to just sort of say, can we get this cheaper? So yes, we are very, I would say, cost conscious, but we're not going to let the cost drive the investment selection. I don't think that is the right answer.
Yeah, very good. And I suppose in talking about active versus passive, an area where, although it exists in the passive world, I suggest an active manager is adding an awful lot of different analysis and value into it, is ESG investing. So, am I right in saying that you've been sort of a driving force in ESG investing, or whatever it was called back when you first started focusing on it, since your arrival at Rowan Dartington some 10 years ago?
I go back a lot further than that, actually. Yes, I've been at RD for 10 years, and within a short time of joining, I set up what we call the ethical environmental model, which is a collective-only vehicle. But at my previous company, I was also running portfolios which were, I think we called them SRIs, so socially responsible investment vehicles at the time. And even in the late 80s, I was championing the Jupiter Ecology Fund whilst working at Hargreaves Lansdown, much to the amusement of Peter Hargreaves at the time, who I think thought it was a waste of time, but he let me do it. So yeah, I've been there a long time.
Okay, and in that time, we've mentioned it a couple of times that the names have changed: ethical, sustainable, etc., responsible, impact even. But within ESG and the phrase that encompasses kind of all of those principles and more, what does it mean to you and to Rowan Dartington?
Yeah, the whole naming convention has become quite challenging in a way. I mean, what is ESG? We know it's environmental social governance, but really saying you're an ESG fund doesn't necessarily confer anything on you. It's about how you use that information. So in some regards, you can look at ESG as another set of data, another set of metrics about a company. What's its impact on the environment, society? Obviously, the governance bit is something that's been around a long time. SJP have coined the phrase, prefer the phrase responsible investment, and I think that's quite a good phrase. And then sustainability is becoming more and more center stage in, again, the descriptions being used. So I think what we're doing is, first off, integrating ESG metrics into the analysis. Whether it's direct stocks, whether it's funds, just looking at how the managers are using that ESG data to inform decisions. So are they using it just as another set of risk tools, or are they actually saying, no, look, this company from a ESG sustainability point of view is actually providing a product or a service which is helping solve some of these issues that the world faces. So we are, because of the nature of our client base, so we've got some clients who are very, very ESG focused, and you've got some who, a lot, you might argue, who are legacy clients who came to us, you know, without any ESG mandate at all. So we do kind of have to consider it in the round, but absolutely embed it. At the very least, for some clients, it will be another risk metric. At the other end, it will be a key determinant of how we construct a portfolio.
Yeah,
so,
yeah, and I think you know, obviously we hear it in investment phraseology all the time now, even in mainstream, you know, newspapers and commentary. But it's something that has been obviously adopted all the way across SJP and by, you know, by our managers that we, you know, employ, etc. And it's nice that on the discretionary side we're doing that as well.
Yes, and we have done a lot of work this last year with SJP to align what is called a minimum viable ESG proposition, which all the SJP fund managers will adhere to. Obviously, because we run ESG portfolios, we're taking that ESG analysis to a much higher level for those clients who opt for that those models.
Yeah, good. And I think one sort of last topic for today before we wrap this section of the podcast up. In the last, I suppose, we've seen a lot of this increase since the financial crisis, particularly with the advent of cheap money. You know, low interest rate environment we've been in, you know, the tech startup boom. You know, what we've seen is an increase in private money in the world. You know, companies seeking seed capital and building and growing on that private money and getting further and further rounds of investing, you know, along the way. Do you see this as a damaging thing for the everyday private investor if companies are not going to the traditional methods of going and listing on a stock exchange to get investment and do that so that everyone can participate?
No, I can't say that I have seen it as a problem. I mean, there's an awful lot of stocks still out there in the world to choose from. I think you know, when you look at across the world, you know, there are tens of thousands of opportunities. So I don't think we're short of opportunities. And I think also from our point of view, certainly in the UK, we can invest in private equity investment companies. So you've got that slightly odd thing where it's a quoted vehicle as it's an investment company, but it invests in private equity. So we can get access to it that route. And I think in the future, it will become a more prominent part in portfolios, perhaps higher net worth, perhaps higher risk portfolios. I think that's the direction of travel. Quite how that will come about, I'm not at this point sure. I believe SJP are doing some work on it that would involve the DFM side as well, because it would be good to access in a way those private equity, private debt markets, because they have, you know, as you said, small companies, great opportunity, and potentially volatile, but it would be best if you could access them in a way directly rather than through an investment company. So no, I don't see them as a problem in the fact that there's an increased flow in that direction. But I think it's something it would be great to be able to get more into, although we can to some degree access it already.
Brilliant. Thank you very much, Tim. I think that's probably all the time that we have for this section of today's podcast. I think it's really provided a fantastic insight into discretionary fund management and how Rowan, Dartington and St James's Place can enhance our client investment proposition with this service. And to everyone that's listening, if you would like to know more, please do reach out to myself or us at Select Investors, and we're happy to talk through the services more with you. Thank you very much.
Thank you.